Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
How to avoid an obscure inheritance tax trap on your pension. Pensions are rarely subject to inheritance tax when you die, apart from under certain obscure circumstances. The Staveley case may not be familiar to the readers of my blogs or the listeners to this podcast. This has been a test case in a long, and I mean long, running battle between Mrs. Staveley's personal representatives and HMRC. The Staveley case. Mrs. Staveley joined the occupational pension scheme established by the company she set up with her husband. Following their divorce in 2000, she transferred this to a Section 32 buyout policy, which is a type of pension, as the only alternative to remaining in the scheme. The pension was overfunded, and had she passed away, surplus funds would have been returned to what was now just her ex-husband's company. She stopped all involvement following the divorce. In November 2006, she transferred the Section 32 plan to a personal pension. At this time, she had already been diagnosed with terminal cancer. At the time of the transfer, her principal goal was to ensure her ex-husband did not benefit from her pension on her death. She was not aware of the A-Day changes, which came in April 2006, which meant that this would no longer be the case with the Section 32 policy. Mrs. Staveley died in December 2006. HMRC claimed inheritance tax was payable on two counts. One, the pension transfer was a lifetime transfer of death benefits, and two, omission to act, as Mrs. Staveley chose not to take benefits in her lifetime. The omission to act is no longer relevant to pension drawdown cases. For deaths on or after 6th of April 2011, not taking income drawdown, even in ill health, would not alone lead to inheritance tax being payable. It is the point on transfers that is of continuing relevance. All pension transfers made in the 2 years prior to death have to be reported to HMRC on Form IHT 409. Where the individual was in ill health at the time of transfer, like Mrs. Staveley, then this could potentially be a lifetime transfer and liable to inheritance tax. This case has been back and forth through the courts, and in August we finally had our answer in the form of a decision from the Supreme Court. The decision. The first tier tribunal found the transfer was not subject to inheritance tax, a decision upheld in the upper tribunal. HMRC appealed, and the Court of Appeal held that the transfer did give rise to a charge to inheritance tax. This was then taken to the Supreme Court to give us a final ruling. The argument that inheritance tax was not payable was based on Section 10 of the Inheritance Tax Act 1984. This clause states that a disposition is not a transfer of value if it is shown that it was not intended and was not made in a transaction intended to confer a gratuitous benefit on any person. Therefore, the case all hinged on the motive for Mrs. Staveley's transfer. Was it to benefit her two sons, who were the beneficiaries of the personal pension, or was it to stop funds going back to her ex-husband? The Supreme Court found that the transfer had not been motivated by any intention to improve the son's position, and that Mrs. Staveley's sole intention was to stop funds going back to her ex-husband. This means no inheritance tax is chargeable in relation to the transfer. What this means for future ill health transfers. The final decision is welcome news and does provide some comfort that anyone with health issues who transfers in the 2 years prior to the death will not automatically be caught in the inheritance tax net. However, it is not a free ticket to transfer inheritance tax free. The key to this case is all about the intent. What is the reason for transfer? If it can be demonstrated that the motivation is not about improving death benefits for someone else, then the transfer can be made with a greater degree of confidence. This will allow pension holders with health issues to transfer when it is in their interests in their lifetime. for example, to improve service, reduce fees, or take benefits in a different form, without fear of their funds being caught by inheritance tax on their death. Whilst it is likely that this ruling will give HMRC less appetite to pursue pension lifetime transfer cases, it is nonetheless crucial that evidence is retained that the decision to transfer was for reasons other than to confer a gratuitous benefit. In the Office of Tax Simplification's second report following its recent inheritance tax review, it looked at the issue of pension transfers and noted that the guidance from HMRC in this area is not particularly clear. In reference to the Staveley case, the 2019 report stated that it expected HMRC to revise the published guidance once the appeal process has been completed. In the absence of simply removing pensions from inheritance tax altogether, this further clarity will be very welcome. In our experience, even if a pension is transferred when the individual is in ill health in order to benefit a beneficiary, and that person dies within 2 years of the transfer, inheritance tax can be avoided if the pension is transferred to a pension scheme where the scheme's trustees do not use discretion to pay the benefits, but direction instead. So if you are in ill health and considering transferring your pension, it is vital that you take advice from an expert pensions advisor in order to avoid being caught by this obscure inheritance tax trap. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.